Candlestick charts represent the supply and demand of traders within any given market, and we can use that information to our advantage when we're trading. In this video, we'll learn what candlesticks are and what they're telling us about trade within any given market. Candlesticks represent supply and demand from buyers and sellers. So those buyers and sellers have a battle, and that is represented by the candlesticks. It gives us price and trading information over any given time period. You can choose the time scale for yourself. So each candlestick represents a period in time. If you come over to a crypto trading software like Bybit, I'll leave a link to them in the description. They give a deposit bonus, so check the details via that link. You can choose the candlestick time frame anywhere from 1 minute up to 1 week or anything that you want. So each candlestick represents a period in time where price action is occurring, either buyers forcing the price up or sellers forcing the price down, and we can use that to our advantage when we are trading ourselves. A candlestick is extremely simple, and it has 4 data points within any given time frame. First, you get a price that is called the open price. A time frame must have a specific time. Let's call this 5 p.m. when the price opens, and it's given a line at that point wherever that price is. Now we can move forward and we get a low price within a specific time frame. Let's say within an hour. This is the low because the price has moved down there. This is the open price drawn with a horizontal line, and wherever the price goes to down, you draw this with a vertical line, as you can see here. But within that time frame, you can also get a high price wherever within that time frame, let's say within 5 to 6 p.m., that is the highest price that the asset goes to. And of course, we also have a close price as well, which was 6 p.m. So within this time frame, we have the opening price drawn by a horizontal line. We have the high and low prices drawn by what's known as the wick. And then we have the close price with another horizontal line. Now, when the close happens, you draw the body. So we have the wicks right here, up and down, and we have the body in the middle when the time period closes. Because the close price is above the open price, this is a upwards candle and it's colored in green. You can choose any color though, mostly green. And then we have the next candle starting. So at 6 p.m. and 1 second, the next candle starts with a horizontal line for the open. Now we move forward, that is the open. We have a high price, of course, as you can see here. We also have a low price with the wick, and then we will have a close price as well by that other horizontal line. Now, because the close is below the open, this is of course a downwards candle for the price because the price started here and finished here. So that is a downward movement. And of course, we color that in red, and that is the candlestick anatomy. Candlesticks can give us both bullish and bearish signals. Bullish signals are when the buyers are simply having to pay higher prices over that time frame or consecutive time frames. A very large rise to the upside could mean that there are just no more sellers and buyers have had to pay up, hence the very bullish move to the upside in the price, with buyers paying higher prices. If we have 3 consecutive time frames where the price is forced up by buyers as well, we could therefore assume that we are within an uptrend over that time period, and maybe we should be going long too to continue the trend. There is also bullish signals within red candlesticks though. As you can see here, the price action is telling us that within the time frame, yes, it did open at this price and it closed lower. However, within that time frame, sellers forced the price all the way down here, but towards the end of the time frame, buyers pushed it all the way back up to this price. Now that's a bullish signal potentially, because within the next time frame, those same buyers could actually keep buying, and when the next candlestick opens, could force the price higher with that continued buying. That is a signal that we can use to actually trade against. Similarly, we can look at bearish signals and patterns as well. A massive downside move in price action is obviously very bearish, and maybe that will continue into proceeding candles. We can also see these 3 time frames where the price is just moving consistently lower and sellers are having to take lower prices. Again, maybe we're in a downtrend and so that trend will continue. But a green candle is potentially also a bearish signal, as even though this candle did finish up for the time frame, we can see that within that time frame, buyers pushed the price up much higher, but sellers came in and forced it all the way back down again. We could predict potentially that in the next candle, those sellers will continue and the next candle could continue to be a red candle. Again, that's something we can trade against. Traders use candlestick patterns in order to predict where prices are going to move. Patterns often show a reversal in a price trend. As we can see here, we have both bullish and bearish reversals. So a bullish reversal shows a downtrend here, as you can see, but this candlestick is showing a reversal pattern. Sellers forced the price all the way down here, but we have this very long wick, and that wick is showing us that within that time frame, the price trend has reversed. And because buyers are forcing the price back up, we could assume that the next candle, they may continue. And as we can see here, it continued into a bullish reversal of that trend. We can actually look at patterns like this on a specific chart, which I'll show you. But first, a bearish reversal is the exact opposite. This is known as a hammer, and this is known as a shooting star, but they are the same pattern, just in reverse. Again, a shooting star shows an uptrend, and we have buyers forcing the price up, but within that time frame, sellers came in and moved the thing all the way back down. And so we could presume that the next time frame actually continues that selling. On a real chart, you can see it right here, where we actually got a bullish move to the upside, but you can see a massive wick on this candlestick right here, known as a shooting star, or just a bearish candlestick, where buyers forced the price up and then got absolutely trashed by sellers moving in. Now, those sellers continued into the next 2 candlesticks, and you could use that to actually trade as well and take advantage of this price movement right here. If you want to know more about using candlesticks to actually take trades, including how to read markets, trade them, and how to input orders, I have over 50 plus videos in the trading section of the Crypto Investor course, as you can see here. I'll leave that linked in the description if you want to check it out. When trading, use candlestick timeframes to your advantage. When you are trading short term, especially, use higher time frames to understand where the larger trend is. For example, on this 1 hour chart, we've seen a potential trend reversal here from some downward moving prices with a hammer and potential to move to the upside again. Should we trade this long though? Well, use higher time frames like the 4 hour. As we can see here, even though this time frame was actually a downward candle on the 4 hour, we can see that we are still within what is potentially an uptrend with just a small downside movement that may not actually disrupt the further uptrend. We can also go to the 1 day and see where the larger uptrend is. And we can see that even though we have 2 red candles within this, we are definitely still in what I would consider an uptrend in the price. And so this gives you confidence that this reversal may actually be something you can trade. If we look on a real chart of Bitcoin as well, we can see this. For example, during a downtrend, we've seen this price action here, where we might say this is a consolidation moving into some green candles, which may actually go to the upside, but it didn't do that. It moved to the downside. If we can actually see the 1 week chart right here and then reset, we can see that this candle is that consolidation. And we can see that on the 1 week chart, we are in a massive downtrend on the weeks. And also this consolidation was actually a bearish candle because you have the buyers forcing the price up, but you get this shooting star pattern, not bullish. And actually it did move to the downside. So if you use those 2 time frames to your advantage, you could actually take a short position there and you would have benefited from that downward price movement. I'll leave some more free trading strategy videos down in the description.